Warriors! The currency reset. You need to know the game, Warriors. This is a very important presentation. Now remember, I'm not a financial advisor. This is not financial advice. This is just my perspective and how my brain works and how I'm preparing for what I believe is the currency reset. My name is Coach JB. I am the top health and mindset coach in the world. What you believe in your heart, you think in your mind, will eventually become your words and become your reality. If you can see it in your mind, eventually you can hold it right here in your hands. What you repeatedly do gets ingrained in your subconscious mind. What gets ingrained in your subconscious mind becomes an unconscious activity. Warriors, I'm here to show you the game. As you look this way at a pandemic, there's a whole nother narrative going on this way. And we've created a private Warrior Academy. If you click the description down below, you can join our private Warrior Academy, access to my portfolio, exit strategy, cryptocurrency community, cryptocurrency calls, support team, everything you need to be successful. And most of all, my 120-day challenge to teach you discipline, mindset, subconscious mind programming, goal setting. This is the time to prepare for the biggest shift in generational wealth. Now, this is a presentation from my perspective. You'll see all the resources included as well. And I wanted to present this to you guys in this fashion. These are some of the things that I present to my warriors within the academy. And I want to show you how my brain works. So know the game. If it takes a pandemic to change the rules, then what would one create to change the rules? Let me read that again. If it takes a pandemic to change the rules, then what would one create to change the rules? All right. So I'm going to take you through dollar devaluation, and I'm going to take you through facts, figures, numbers, logic, and dates, and share with you where I think we're heading as a country and as a world in regards to our currency. So the first thing that we need to know is about dollar devaluation. So if you look in 1913, now remember 1913 is when we created the Federal Reserve. If you were to buy a chocolate bar, $1 would buy 30 Hershey chocolate bars. That same dollar today will buy you one McDonald's coffee. So the same dollar in 1913, it now takes 26.14 cents to buy the same amount. So I want you to think about this for just a moment. There's a couple key dates right here. So one of the key dates is 1971. That's when we detached from the gold standard. So President Nixon announced that we detached from the gold standard in August 1971. The World Economic Forum was created in January 1971. And ever since then, our dollar has devalued dramatically. It is not backed by gold now. So the only reason it has value is because of our belief in it or our faith in it. And I want you to think about something just a moment. So your dollar has inflated over 2,000% since around 1913, since the dollar was created. You want to quote, don't quote me on that, check those numbers, but around 2,000%. I want you to ask yourself a question. Has your pay gone up dramatically? It has not. Productivity has gone through the roof, but the value of your dollar has gone down. So we're stuck in a debt-based cycle. We're stuck in a printing machine, and I'm going to take you on a journey of the last couple years and what I think is about to happen. Now, this is just my opinion. This is not financial advice. Do not make any financial decisions based on this. I just wanted to give you some insight on how I make my financial decisions. Okay, so in 2019, they had the quantitative easing to fight the next recession in 2019. Now, let's go back to 2019. Our lives were completely normal. Right? We weren't thinking about the C word. We weren't thinking about the pandemic. Everything was completely normal as we went into November, December. The Feds had already cut interest rates twice in response to the loss of momentum in the U.S. economy. Those rate cuts, down an average of 1.75 to 2%, have eroded the Fed's limited firepower to fight the next recession. So UBS has warned the U.S. GDP growth will tumble to near zero, okay, forcing the Feds to slash interest rates by another percentage point between now and the first half of 2020. So we've got a pretty massive slowdown in our forecast, said Rob Martin, U.S. economist of the UBS. So they were talking about this in 2019. So they were preparing for a big economic downturn and a lack of GDP growth. Now, GDP is the gross domestic product. It's all the products and services in all of America. We are a negative debt-to-income ratio, which I'm going to show you down in the end of the presentation here. So they were already preparing for a recession coming up. Okay, I want you to think about the date, 2019. Life was normal in our perspective at that point. Okay, so we're going to watch just the first part of this video right here, and I want you to see what the World Health Organization said in watch this. So in 2020, what are they talking about right here? So COVID, oh, excuse me, I shouldn't have said the word, but the C word hit the world in January 2020. Okay, then it was heavily embedded in March 2020. But I want you to listen to this video in 2018. So it said, if you're just listening to this verbally, it said, long before the C word and pandemic, who urged the world to prepare?
A devastating epidemic can start in any country at any time and kill millions of people because we're not prepared, because we're still vulnerable.
So that was back in 2018. So they warned us. Then December 30th, 2019, there was the first appearance of the C word in China. Okay. So now we have QE starting in 2019. They're preparing for an economic downturn. They were predicting low GDP growth in 2020, but maybe I'm not an economist. So why were they already predicting low GDP growth? And then all of a sudden, they said in 2018, we were not prepared for the crisis that we're going through, okay? Now check this out, okay? We go a little bit further. Now this is really important to understand. So QE, quantitative easing, since March 2020 to June 2021, look how much money has been printed. This is March 11th when they started doing the stimulus, okay? March 11th, 2020 to June 22nd, 2021, it went from 4.3 trillion to 7.94 trillion that they added to their balance sheet in quantitative easing. Do you realize that every single time this happens, it has a devaluation to your dollar? So think about that just for a moment, warriors. In 2018, the WHO was saying we're not prepared for a pandemic. 2019, they were already preparing for an economic downturn. And then in end of 2019, December, it was in China. We didn't know about that. But then all of a sudden in January, we started to hear our first cases in America. And then by March, our whole lives have completely turned upside down. Okay. Now check this out. The Federal Reserve holds more treasury notes and bonds than ever before. So this is how they do this, the quantitative easing. Okay. So they buy the bonds to pump the economy. Okay. Now we're going to talk about at the end, the meeting that I shared with you guys at the Jackson Hole meeting where Jerome Powell announced that they're going to start tapering. And I'm going to show you that at the back end here. So let's think about this for just a moment. So in 2019, they already started talking about an economic downturn. We didn't know anything about the C word. We didn't know anything about a pandemic. All of a sudden, January, we start to get word of it. By March, by June, our lives are turned completely upside down. I own a fitness facility. My fitness facility was shut down. Couldn't pay my employees. We lost 78% of our revenue. And this is what's happened since March 2020. Okay? This is how many bonds they've been purchasing every single month. Okay? Now we're going to go into this. Then he drops an inflation time bomb in 2020. I think this was around August 2020. So Jerome Powell comes on and shares with you guys, all of us, that we're going to a flexible inflation rate. So now we're in this massive quantitative easing, a very low interest rate environment, and they're about to go into a flexible inflation rate. This was in August 2020. So let's listen to just this real quickly.
The Federal Reserve announced a major policy shift Thursday, saying that it is willing to allow inflation to run hotter than normal in order to support the labor market and broader economy. In a move that Chairman Jerome Powell called a robust updating of Fed policy, the central bank formally agreed to a policy of average inflation targeting. That means it will allow inflation to run moderately above the Fed's 2% goal for some time, following periods when it has run below that objective. The changes were codified in a policy blueprint called the Statement on Longer Run Goals and Monetary Policy Strategy, first adopted in 2012, that has informed the Fed's approach to interest rates and general economic growth. As a practical matter, the move means the Fed will be less inclined to hike interest rates when the unemployment rate falls, so long as inflation does not creep up as well. Central bank officials traditionally have believed that low unemployment leads to dangerously higher levels of inflation, and they've moved preemptively to head it off. However, a speech Powell delivered to a virtual gathering of the Fed's annual Jackson Hole, Wyoming Symposium, and in accompanying documents that codified the new policy, signaled a shift away from the old thinking. Many find it counterintuitive that the Fed would want to push up inflation, Powell said in prepared remarks. However, inflation that is persistently too low can pose serious risks to the economy. The chairman's speech began 2 minutes before the scheduled 9:10 a.m. Eastern Time embargoed release that financial markets had been expecting. His remarks did not initially draw a strong market reaction, but stock market futures later moved higher. Powell
Okay, so we'll stop right there. So what I want you to understand is what he talked about.
The Federal Reserve
came on and he talked about a flexible inflation rate, right? So they were going to run inflation hot, right? And I'm going to show you the exact numbers right now. But why did they need to start to pump up inflation with interest rates so low? Remember, our society runs off interest. When you have a low interest rate environment, you're starting to cut into the profit margins of the central banks and the banks, the commercial banks, okay? So now how do you pump the economy? You raise interest rates, products, goods, and services, right? So you're getting these pay raises, but here's what's happened to your consumer price. So U.S. consumer price spiked by 5.4% over the 12 months ending in July. That tied with June for the fastest annual consumer inflation since 2008. So we're in a low interest rate environment. They're pumping money into the economy. And as you go out and spend money on the products, goods, and services, they're raising the cost of those products, goods, and services. Okay. So low interest rate environment, quantitative easing, bond purchases, higher inflation, so your products, goods, and services cost more, but you're getting the money from the government, and it's just this vicious cycle that we're printing into oblivion. Okay, so the inflation numbers, so now we know that in 2019 they were preparing for something, then all of a sudden we get hit with this C word, right, going into January, then by March our lives have been turned completely upside down. We looked at the numbers of how much money's been printed. More money's been printed in history from 2020 to 2021. The bond purchases every single month are going to continue, which I'm going to show you because he said we're likely to taper. He didn't say they are going to taper. He used the word likely. And I just want to show you where we're heading to in the currency reset. Somebody I'd highly encourage you to go to follow and check out is Lynette Zhang. Lynette Zhang is phenomenal for this type of education. Okay, let's move. So we got the debt limit, okay? So the debt limit suspension, so the Congress, they're on recession right now, right? After summer session, they have to come back and decide on this. They actually pushed it back, and I think it was on in August. Yep, here it is right here. Oh, but no, this is another thing I want to bring up to you guys. Why? Okay, so in August 2019, they suspended the limit through July 31st, 2021. Okay, so remember, they talked about quantitative easing in 2019. We didn't know about the C word yet, right? Okay, they were already predicting low GDP growth in 2020. And then they suspended the debt limit ceiling from August 2019 to July 31st, 2021. So what that means is they took the cap off the debt ceiling so they could run really hot and go over, right? And the debt ceiling is 22 trillion, and we're right now at 28 trillion. So that's where my brain goes. And I would love to hear in the comments down below if any economists or anybody if I'm looking at this incorrectly, but they raised the gap or the ceiling or took the suspension off the ceiling so they could run hot in August 2019 all the way through July 31st, 2021. So now we come into August 1st, 2021, the debt limit will be reset to the previous ceiling of 22 trillion plus the cumulative borrowing of the occurring during the period of suspension. So the position that we're in right now as a government, okay, we're printing to oblivion, low interest rate environment, okay, we got the Delta variant kicking in. We have reached the debt ceiling. It needs to be reset back down to 22 trillion. So if they do not give them the ability to extend the debt ceiling or go back into a suspension of the debt ceiling, the government will start to default on their bills. Okay, they can't even pay their bills. They have to borrow to pay for their bills. Okay, so the debt ceiling, the CBO projects that if the debt ceiling is not raised, the Treasury would probably run out of cash and be unable to make its usual payments starting sometime first quarter of the next fiscal year, most likely in October or November, July 2021. So what they're saying is if it's not raised, they won't be able to pay their bills. What is that? Social Security, veterans benefits. Those are some of the biggest things, and I'm going to show you the debt calculator at the end here. So I'm just kind of giving you this broad picture of what's going on. You got an overvalued stock market by 238%. If you look at the Warren Buffett indicator, we have a debt ceiling that's been reached and has has to be basically raised, or America won't be able to pay its bills. Okay, we have quantitative easing that's been more money printed than in history. You have a low interest rate environment, and now you got Jerome Powell saying that they may start to taper on the back end of this year. Okay, so we talked about this. They said what they can do is they can tap into their toolbox and use extraordinary measures think about this. So they reach the debt ceiling. What's coming out now? Delta. I'm not saying that this is not real, but the Delta variant's here, and you need extraordinary measures to be able to raise the debt ceiling again. Okay? All right, so we're going to take a look at this, give you a little bit of a description of the debt ceiling.
At the end of the month, the Treasury Department will suspend the sale of bonds, the avenue by which the U.S. finances its debt obligations. While the United States has never defaulted on its debt, recent history shows that getting uncomfortably close to it can create chaos. A failure to work out differences among lawmakers over whether government spending cuts should accompany an increase in the statutory debt limit, currently set at $28.5 trillion, could lead to a federal government shutdown, as has happened 3 times in the past decade. Janet Yellen has sent numerous notices to Congress, a required formality when the outstanding debt of the U.S. nears its statutory limit. She said that after August 2nd, and barring a debt limit agreement, the Treasury will start taking extraordinary measures to pay for Congress's legal and financial obligations, a temporary fix that allows the Secretary to tap additional government accounts for a period of weeks. Yellen did say there are scenarios under which Treasury's cash and extraordinary measures to continue borrowing could be exhausted soon after Congress fully returns from its summer recess in mid-September. She also said that October 1st, the first day of the next fiscal year, could be a critical date for the U.S. ability to pay its obligations.
So that's where we're at right now. Well, they're in summer session. They're coming back on October 1st. U.S. may not be able to pay their obligations. So let's look at GDP to debt to income ratio, and we'll start to wrap this up. So in 1960, so GDP is gross domestic product. So all the products, goods, and services in America, if we were to sell all of them, we would not be able to pay off our debt. It's a debt to income ratio divided, okay? In 1960, we're at a 52% debt to income ratio. Pretty solid. 1980s, we dropped down. We had a very favorable debt to income ratio at 34%. 2000, right before 9/11, we're at 56%. And then since 2000 to now, we're at 125%. So this means that our debt is 125%. So for example, let me give you a real world example. If America was to walk in to buy a car, we would not be able to buy a car because of our debt to income ratio. We have more debt than we do products, goods, and services. Now, when you look at the Warren Buffett indicator for the stock market, that's why he overvalues it by 238%. What he takes is the overall market value of the stock market and divides it by the global GDP, and the gap in between the two is the overvaluation. You have companies, because of the quantitative easing, the printing of money, that have billions of dollars in value but have not put any GDP, if I'm saying that correctly, or any products and goods and services, or had any growth during the current pandemic. Right? So you have all these overvalued businesses, and your faith in the stock market, because it's showing favorable on the books, but they're actually not growing the economy. So we're in a dangerous place right now. Overvalued stock market, printing into oblivion. We have a low interest rate environment, and Jerome Powell says that they are going to start tapering on the back end of the year. So here's where I think that the currency reset's going to come in. This is my opinion. The SDR currency reset. Now, the SDR is the IMF's bags of currencies, right? The global currency, like SDR, is needed to extend the ability. Key. The global currency, like SDR, is needed to extend the ability for the governments to print money out of thin air. The U.S. dollar has a lot of power. It seems impractical in the future that the majority of global trade will be done with one country's currency. It's unfair, and the system wasn't designed for it. Well, guess what just happened, Warriors? The SDR on August 31st, it was a historical moment. The SDR, created by the IMF in 1969, they started printing money basically at the SDR level. Okay, $456 billion was approved on August 2nd, 2021. It was effective on August 23rd, 2021. The most recent allocation was addressed to long-term global need for reserves and to help countries cope with the impact of the C-word and pandemic. The value of the SDR is based on a basket of 5 currencies: the U.S. dollar, the euro, Chinese renminbi, and Japanese yen, and the British pound sterling. So think about this, Warriors. They are now printing at the SDR level. This is a sign of a currency reset or a shift into a new financial system. So this was what just came out just recently. So he said the Feds are likely to taper. So it didn't create usually when they say that, yes, we are tapering, that will create a huge pullback in the markets, because what the elite money, the whales, are like, oh crap, they're going to stop printing money, because what's happening is Cantillon effect. The money is printing, it's going to the top of the house, and they're investing into assets, and it comes down to the working poor, and the working poor go out there and put it into the economy, and they just raise your gas prices. Inflation goes up. So they're taking the very money they printed, and they're creating growth in the economy by inflating your products, goods, and services. It's a vicious cycle. They're not doing the same thing with their money that the people working poor are doing, right? So Powell sees tapering by the end of the year, but says there's much ground to cover before the rate hikes. So this is important, because when you start to taper, that usually means rates go up. So now interest rates go up. You could go into hyperinflation, and that starts to shut down the markets, right? So I think what they're doing is they're getting set up at the SDR level, and I believe a big currency reset is coming. Maybe not this year, but I think throughout the next 5 years, we're going to see a big shift in our financial system. That's why most of them are running to CBDCs. Okay, I just wanted to show you this and have some fun with you guys around the U.S. debt clock. Okay, one of my favorite things to look at here. So if we just open this up a little bit here. So this is the actual U.S. debt clock, okay? So this is really neat. So the U.S. debt right now is at $28 trillion. And do your research. Make sure you verify the numbers. The U.S. gross domestic product's at 22. That's where you get the negative debt to income ratio. Let's look at a time machine here. If we go at this pace until 2025, when I've been telling you I believe everything's going to reset by 2025, my opinion only. If you go to the future, look at the difference. We go to 49 trillion in debt, but look at how little the GDP goes up. This is a time machine. This is their prediction. Only 27 trillion in gross domestic product and 49 trillion in debt. Look at how much the debt goes up and how little the GDP goes up from 21 to 2025. 22 trillion, 28 trillion. This goes up to 49 trillion, and this goes up to 27, 26? So we take a look. So Warriors, I just wanted to leave you with this slide right here, Warriors. We are at a critical time in history. So I'm just here to give you information. I'm not asking you to believe a word I say. I just want to give you some insight on how my mind works. I believe this is one of the most historical times that we will ever experience in our history. Picture the Great Depression, 1929. They didn't have access to information like this. They didn't have access to YouTube or sharing information so you can go make informed decisions. But like I said, I'm not a financial advisor. None of this is financial advice. This isn't about, all these cryptos going to the moon, how you're going to become a millionaire. But when you understand this stuff, you can understand the game. And when you understand the game, you can make better decisions, Warriors. So if you want to be part of a community who is working together in the game to lift each other up, to build intergenerational wealth, you can click the link down below, join our private Warrior Academy. Okay, now listen. Also, my only Instagram page, there's a lot of scammers out there, is in the description down below. So make sure you follow me on Instagram. We also have a free Discord, free Facebook group. We have everything you need to be successful in the crypto space, mindset space, and health space. As we always say, Warriors, rise. Get your shit together. Let's go.